So Trump might have finally found a bigger bully than himself. If you haven't been paying attention, the bond market has been flashing red since earlier this week. On Monday, I made a video talking about how stocks were plunging, but in a rare move, interest rates on US Treasury bonds were spiking at the same time. Normally, when stocks crash and recession risks rise, you'd expect rates to go down, not up, because investors usually flock to treasuries during times of stress. That pushes their prices up and interest rates down. But not this time, and it's making a lot of people nervous. And since Monday, this trend is only intensified. On Wednesday, the yield on the 10-year Treasury briefly topped 4.5%, while the 30-year yield topped 5%, both significantly higher than they were just a few days earlier. The spike in yields was so sharp that it seemed to have forced President Trump to blink. On Wednesday, he essentially admitted that the bond market was freaking out about his trade war. And so he announced a 90-day pause on many of the tariffs that he had rolled out just last week. That move calmed markets for about a day. Stocks surged and yields dropped, but the relief was short-lived. Today, yields are rising again. Rates on the 10-year and the 30-year are hovering just below Wednesday's highs as investors continue to fret about Trump's trade war. Remember, he paused some tariffs, but he also jacked up tariffs on China to a whopping 145%. That's a level that could severely disrupt trade with one of America's most important trading partners. And it could cause massive ripple effects across the economy. Every day these draconian tariffs stay in place, confidence in the U.S. economy gets shakier. It turns out slapping massive, unpredictable tariffs on your trading partners, flip-flopping every other day, doesn't exactly inspire confidence. We've talked about this before. The U.S. runs a large trade deficit, meaning we buy more from the rest of the world than they buy from us. But the flip side of that is the financial account surplus that we have. Foreign money flows into the U.S. to buy assets, stocks, real estate, and most importantly, treasury bonds. Because the U.S. has historically been seen as a safe and attractive place to invest. In 2024 alone, foreign investors poured $2 trillion into the U.S. They increased their holdings of U.S. Treasury bonds to $8.5 trillion, about 30% of all publicly held U.S. debt. But that dynamic might be shifting. Rising yields suggest that foreign investors might be backing away. They might be starting to question whether the U.S. is the safe bet that it used to be. Another red flag is that the U.S. dollar is plummeting. If it drops any further from here, it'll hit the lowest level in 3 years. And that's especially weird because the dollar is falling at the same time that interest rates are rising. That's not how it's supposed to work. Normally, higher interest rates attract foreign capital and strengthen the dollar. In fact, analysts at Evercore called the current situation highly abnormal. They noted that in the last few decades, there have only been 4 other times when the US dollar dropped to 1.5% on the same day that the yield on the 30-year Treasury increased by more than 10 basis points. So this definitely isn't business as usual. Something is going on. The bond market is sending a message, and it's not one that Trump should ignore.